Per usual, living on this channel is for educational purposes only and is not intended as financial advice. It is Tuesday, Teaching Tech Tuesday. Realized I haven't talked about moving averages yet. Kind of the basis of most trend analysis, trend strategies, many indicators, including the cloud, borrow principles from moving averages. It's important to know the basics, how to use them. Most people at this point, well, if you're watching this video, intuitively probably know various aspects of moving averages, but I'll blow your mind here a little bit, give some alpha when we're talking about the charts. So the bare bones basics, so nomenclature, you'll see moving averages referred to as MAs. Sometimes you'll see SMA, WMA, EMA, SMMA. They're all just different ways to calculate the moving averages. So if we're looking at a 200-day moving average, a simple moving average would literally just be what is the value over the past 200 days. A weighted moving average will weight the most recent data higher than day one. So it'll weight day 200 more than day one. And then the exponential moving average will also weight most recent days more, but in an exponential fashion. I used to use the EMAs a lot. I think for crypto, EMAs probably are more important. It's just when you're communicating moving averages, people don't use EMAs. So it's hard to explain that every single time. And there is validity in watching stuff that everyone watches, like the 5200. It might not be best for entries and exits if you're just following the herd and following what everyone else is doing. You know, you want to beat the herd, right? But if someone's talking about Bitcoin's golden cross today or yesterday, and you're like, no, that's not what my chart shows, right? Maybe you're not using what they're using, just something to consider. And the bottom line for this entire video is it doesn't matter what you use as long as it helps you make money, right? Use whichever MA or don't. Whatever you're comfortable with, whatever cross you're comfortable with. The 5200 is the most common. 200 days is 40 trading weeks in the legacy world. The other question I get asked as far as length and time frame is, you changed the cloud settings, why don't you change your moving average settings? And you can, right? We can use like 91, 365 or something, right? I don't think that necessarily helps you most of the time. Crypto's unique in that when it's volatile, it's super volatile. When it's dead, it's super dead. So you have to dial in that noise to signal a little bit. And sometimes going up on the time frame significantly means you will miss entries, you will miss exits if you're just using basic moving averages, right? So aside from type and length, time frame is also baked into length because we can look at the 200-week moving average on the daily time frame. If we multiply that by 7 days in a week, we get to 1400. So that may be a common critique that's easily fixed if you just change the moving average based on your time frame if you want to look at a 200-week moving average as an example. So we can add different numbers of moving averages, a simple cross like the 5200, the 1050, the 921, the whatever, right? There are certain systems like the Williams Alligator uses the 5813. I have a whole video on that on this channel. You can check that out. Then there's stuff like the Guppy, which I think uses 12 moving averages, which I'll talk about as well. If a cross wasn't alpha enough for you, how about 12 MA? But no, people use the Guppy with success. I don't personally. Purpose obviously is to smooth the data over time. That's what moving averages help you do. Help you remove noise, help you take the volatility out of it, and help you discern a trend. Are we rising? Are we falling? Are we flat, right? Where's the momentum? Helps you do this quickly. Any asset, any time frame, any sector, commodities, equities, whatever, right? From the trading side of it, you can also use moving averages to provide entry, exit, and stop loss. I'll talk about that. For me, I use the cloud. The cloud's a variation on moving averages. I like the cloud better, but you can use moving averages for this purpose. And then lastly, I'll talk about moving averages relative to overbought and oversold conditions. Much like the cloud, vanilla moving averages can be used as an oscillator, right? You don't need RSI, you don't need MACD, you don't need Stoke, you don't need whatever, right? For the most part, you can use what you're using in a very basic way to determine, are we super overbought? Are we where we should be based on trend? Historically, what are the highs and lows here? And then are we due for a mean reversion type of move where I need to take some off the gas to take profit or whatever, right? Protect myself from the downside or upside if you're short. And I looked at Investopedia article talking about 7 pitfalls of moving averages. So let's go through them real quick. Moving averages draw trends based on past price information. That's true. That's all TA does is it looks at the left side of the chart to try and predict the right side of the chart. They are inherently lagging. Some people don't like that. There are ways to fix that. Again, the cloud sort of mitigates against that by displacing the cloud in front of price to try to head that off the pass a little bit, but it still uses the left side of the chart to predict the right side of the chart, right? Valid criticism, that's all of TA, right? Number two, I don't understand this entirely. It's saying, moving averages can't be used for anything, and that's completely false. I see no problem with using the same moving averages across all industries, including crypto, including whatever else, right? Number three, moving averages can be spread out over time, can be problematic. General trend. Again, we can use the 1400 moving average for the 200 week. We can adjust, right? We can use math to adjust that. I don't think that's really a valid critique either. This is an interesting one talking about number four. Are we using EMAs or SMAs or WMAs or SMMA or whatever, right? Again, for crypto, I do think EMAs are better. I do think they're better. Especially because I don't think many people use them. So you're not using what the crowd is using. You're beating the crowd, ideally. You're beating them on entries and exits. And I just think it's all about vibes. Crypto's about vibes. So it's all about the vibe. What are the vibes this week, right? What are the vibes over the past month? I don't care about the vibes 150 to 200 days ago, right? What matters now is the recent stuff. That may be more of a crypto thing, but EMAs are definitely valuable for sure. Number five, some investors think TA is meaningless. Basically, it doesn't predict market behavior. That's fine. I'm not going to disagree with you. I don't care. I think the market has memory. So I think that's invalid. It is what it is. We don't need to argue about that. Number six, cyclical pattern not captured by moving averages. Yes, if there is no trend, moving averages get extremely noisy and you cannot use them, arguably, as a signal. Although I would counter and say that in and of itself is a signal. If your high time frame EMAs or MAs, whatever, are crisscrossing over and over and over, that's a signal saying there is no trend. We are neutral. We are flat. That's okay. Everything's a data point, right? So although number six is a critique, I would say it's a strength if you know what you're looking at. And number seven is kind of like number six. If there's no trend, you can't tell where it's going. Sure. But again, you can use moving averages. They're not perfect. They are lagging. They do have some weaknesses, but it will help you assess sentiment and trend extremely quickly on any given day for anything. So they, in my book, are extremely useful. Before we get into the charts here, let me talk about today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with a link in the description of this video. And on Kraken Pro, you can search for indicators. And again, you can look at moving averages. You can look at all sorts of fun stuff. There's many things you can do with moving averages that I'm not going to talk about in this video, but there are a ton of indicators. And if you just type in MA, you can add MA cross with EMA, EMA cross, all sorts of fun stuff, right? Triple EMA. I just like the vanilla MA cross. You'll see me turn that on and off every once in a while. Bitcoin still looks good here. It looks like it's triangling out, ascending triangle, equilateral triangle. Either way, that points to bullishness. What we don't want to see is a descending triangle here. That typically means bearishness. If you're bullish, you might be bearish here. But all right, let's take a look at some charts. Over the past 2 days, we've had the 5200 bull cross. The slow moving average is below the fast moving average, also known as a golden cross. Now, we had a death cross not that long ago, and quickly you'll see the critique people provide with moving averages. Well, we had a death cross, but we didn't go down. I'm not going to disagree with that, but it isn't necessarily telling you, hey, short everything here, right? I would argue a cross after an extended move is a huge signal. We had a year-long bearish cross on Bitcoin here. The death cross didn't catch the top, but it certainly got you out of trouble with plenty of time to spare, right? This is hindsight. I know that. But you do have to know a little bit about where are we in the cycle generally? Where are we now in the cycle generally? Are we more favorably bullish or bearish? I would argue we're more favorably bullish. So a crisscross on moving averages, these are just simple moving averages, by the way, suggests to me that we've regathered strength and are ready for additional bullish continuation. Certainly no guarantee, just as there wasn't any guarantee in January, February this year whenever we had our golden cross, but that was the first golden cross since the 365 days prior, right? We were also back above the red line, the 200-day moving average, for the first time in a long time. So when you're talking to people about technical analysis, they know what the 200-day moving average represents. They know that generally, if we're below, we are bearish. If we are above, we are bullish. So it's a great communication tool, if nothing else, for trend. So historically, the 5,200 on the daily has meant something for Bitcoin. Has it been the best cross for trades, for entries and exits? No, but it's generally giving you a pretty good idea of what's going on. And you can do backtesting and say, okay, let's look at every single cross from 0 to, well, I guess 1 to 50, and then from 50 to 200, right? And let's do some backtesting. People have done that. I believe the 1050 is actually the best as of, I think it was 2020 when I saw that backtest from Bloomberg, but that may change over time. Maybe it's the 921. I don't know. But generally, you get a good idea of what's going on here. I always like to look at, just visually, I don't need to run the numbers, what did this look like in a bull trend? What did this look like in a bear trend? How noisy was this on the daily chart? And generally in a bull trend, we're above the 50, which means we're well above the 200. Generally in a bear trend, it's the opposite. And if we are closer hugging the 200, it is generally a weaker trend, as it was this year, right? This year we've hugged the 200. Whereas last year, we were far below the 200, which tells you again, what is the momentum and strength here? It was quite bearish, right? And look at 2021 as the inverse, right? We were well above the 50 the entire time until the very top, aside from the early breakout, right? 2016, 2017, we had several momentum resets in here, didn't quite retouch the 200-day moving average, but it gives you some flavors here of what we can expect. 2019, that mini pre-halving rally also held well above the 50. So when we have the momentum, we generally have significant momentum in either direction. And when we are just chopping around, as we were in 2020, there really isn't a trend. So what does this tell you? It tells you the trend is your friend until the end. 5,200 is certainly useful. Here's the 1050. You know, if I was trading moving averages, this is the type of thing I would want to see. I would want to see quicker entries than the 50 and the 200. It's been quick enough this year that the 1050 looks good. But again, it's not going to be perfect. It's going to stop you out if you're just using the cross, right? So the bull cross, you're long, bear cross, you're out, or you're short, right? Depending on if you want to flip-flop based on some higher time frame, moving average or something else, right? If we're just using moving averages here. So the 1050 would have got you in September, basically, right? Would have got you out July, etc. So you'd have to backtest that and see what you're most comfortable with. Now, if we add on a moving average, this is the alligator, Williams alligator. Typically, if somebody makes a system, it is somewhat backtested and using specific moving averages, just like the cloud. That was backtested. That was using specific values, but it doesn't mean you can use whatever, use whatever value you want. It's not the end all be all. If you only use the creator settings, use whatever works for you. Alligator works very similarly. You want to see green, red, blue. That is a bullish cross. If you're bullish, you want to see blue, red, green. If you're bearish, you can see where it got you in here before the move. And that's what you want to see, right? You don't want to see in the 5,200 case, we're generally probably not the best cross to use for trading. It's a great sentiment cross. It'll get headlines, but it's generally not the best thing to use as a cross for trading. And with the Williams, the midpoint, the red line, acts as a stop loss as well. So if its price is ever below the red line in a bull trend, you're stopped out. If it's above in a bear trend, you're stopped out. Is it noisy? Sure. Is it perfect? No. Can you add additional stuff like Williams fractals? That helps? Definitely. So it's all about comfort and duration and size, leverage, right? What works for you? That's what you have to figure out. Here's the guppy, which to me is a variant on the Williams fractal stuff. I don't know which was invented first, but very similar concepts, right? Bullishness is a complete flip of the faster moving averages above the slower moving averages. I'm sure there are rules here where you can set bids on certain levels or asks on certain levels. Where do you want to see the mean reversion, right? All sorts of fun and interesting rules you can apply on this as a trader, should you so choose. It does give you a sense of trend, strength, that sort of thing. I think it's a little too busy for me, but some people like it. Now, here's where the alpha comes in. Here's where I really blow your mind. Even though this is the 2-day chart, it is the 1-day simple moving average and exponential moving average. And again, based on backtesting, depending what works for you, is it the pi cycle top? Is it something crazy like this, where we're using simple moving averages and exponential moving averages, and we're looking for crosses? Is it late? Is it early? Do we use the 50 and the 200, the 100, the 100? That's up to you. I would encourage experimentation. Find stuff, tag me on Twitter, whatever. But in this case, the 100 gets you in 2020, mid 2020, gets you out at the second all-time high. I mean, this is hindsight again, but interesting how some of these moving average crosses, as I'm cherry picking this one here, work fairly well, right? Either as a trade or a stop loss mechanism. Things can get rather interesting. Here's the 100, again, zoomed out a little bit. So depending on what kind of signal you want, certain crosses and things can be useful. So as a full trading stack, as a system, I would use crosses as a signal for entry and exit. I would also use a even slower moving average, potentially, as a trailing stop loss. So if we're using the 20 and 60 cross here as an example, we could use something like the 15 maybe as a stop loss. We could use the 20 as a stop loss. Totally up to you, right? Depends on backtesting, trend, asset. This is going to be different for different alts. This is going to be different for different time periods, depending on the momentum, which is dangerous and subjective, but that's the truth. And then here, what if we're using the 2060 moving average with a 10 period EMA as a stop loss, right? So there are plenty of ways to skin the moving average cat. Now, lastly, this is probably one of the more important aspects of moving averages. If we take a look at the daily 5200 cross, specifically the 200-day moving average, there's an indicator on TradingView called distance from moving average. And you have to change it a little bit. You have to select SMA, 200 period, great. And this will show you the price above or below that 200-day moving average. It'll give you a sense historically, how overbought or oversold do we get? Where are we currently? And do I need to put on tighter stops based on what the market can handle effectively, right? Historically, in a rip-roaring bull market, we are over 100% above the 200-day moving average, 150, 275 at its peak, right? So that gives you some sense. If we really get going, this is how far away we can get from the 200-day moving average based on historic price action. You can also use this to sort of predict, based on the current 200-day moving average, where could a target be? We could say, well, there's a target between, let's say, 100 and 150% above the 200-day moving average, and that's going to change over time. That's dynamic, but as a rough estimate, it certainly can be useful. And even on the downside, right, on the bear side, it definitely was useful. You can see we've generally bottomed out somewhere between, let's say, 45 and 50% below the 200-day moving average. Now, that doesn't mean we can't keep going higher or lower, but it does give you a good sense of overbought, oversold conditions. I talk a lot about the weekly 200 and the weekly 20 moving average. And to me, this says over time, there's less of a tolerance for price above the 200-week moving average, historically. That may be exactly the same this time. We may see like a 250% maximum. We may see something completely different, right? But it gives you an idea of where this market could go, where we are now, based on distance from the 200-week. And then lastly, I think the 20-week moving average is actually the best thing to use if you're doing a study like this, where you're trying to figure out overbought, oversold, or tolerance for momentum in one direction or the other. So you can pop on this distance from the moving average indicator. You don't have to have the moving average on your chart at all. And it'll continuously just be a sanity check, right? What is tolerable here based on momentum, based on mean reversion potential, right? Historically, let's say 85 to 125 is a reasonable rip-roaring bull market expectation. I don't think we're quite in the rip-roaring bull market stage, but it's something interesting to watch over the next 2 years here, which I think we will get a rip-roaring bull market, if we do, and if it's similar. So I hope this was helpful. Hope you learned something. That's all for this one. Like, dislike, comment, share, subscribe, and happy trading.